the labor market is unusually tight, right? So for the longest of time in the US, the job vacancies exceeded the number of unemployed. Even now, there is that gap that persists. This can go one of two ways. One is the firms get desperate. They realize that they have to increase wages, and they do that. The incomes go up, employment goes up, but at the same time, inflation goes up too. Or the firms realize that they cannot hire anymore because demand is going to slow down very soon. They give up, wages fall, incomes fall, but then unemployment goes up, and we have a situation of recession. I don't think we're in a situation today to be able to predict which way that is going to go. Okay. So I'm going to say that the US situation is relatively unclear. But I do agree that I think after 5%, the Fed is going to hold. And I think this Fed is relatively dovish in the sense that at the first signs of unemployment going up, they may even start considering discussions about when do you start unwinding the tightening policy, so to speak. So it's very difficult to say what's going to happen next year. Now, what I want to focus on is, more than the US, I'm particularly worried about what's happening in the EU. Because I think the European Union is definitely headed towards a recession. Because unlike the US, they are dependent on Russia for natural gas. They're facing an energy crisis. They're facing an adverse terms of trade shock, which has sapped income. The industrial base has gotten very badly disrupted because production has gotten expensive. And you see the inflation rates in EU. I mean, EU has 10%, UK has 11%, is exorbitantly high levels of inflation. They haven't even started the kind of monetary tightening that the Fed is doing. They're lagging behind. So I would say for emerging market perspective, much of the risk lies in the European Union to the extent whichever EM is exposed to the EU definitely runs the risk of a lot of volatility. And there are also financial stability concerns in the European Union. So in the US, despite a 3% increase of interest rate, the financial system has been extremely resilient. Because after the 2008 crisis, the US financial system got much more conservative. We are not seeing any kind of financial sector blow up. But in the European Union, there are financial stability concerns in UK, in Italy. So that, to me, would be the main area of concern. And again, China is the uncertain part in all of this as well, because we recently know China is really struggling to deal with COVID despite the zero COVID policy. So again, whichever EM, whichever country is exposed to China will end up facing that heat as well. So I'm going to stop here with the external sector and just stop by saying we are facing radical uncertainty of a kind that we have not seen during our lifetime. And any kind of forecasting, be it GDP growth, be it inflation, it has become that much difficult. And I'm happy to talk about India if there's a chance. Thank you.
Actually, my job has become very difficult now. I thought I'll get a clear-cut answer on whether you're going to have a continued recession or a serious recession, or you will have a shallow recession. All of you have told me that it is too dynamic, too uncertain, and you all are not going to veer this way or that. It is none of the above kind of vote, or we will not vote kind of answer that I have got. Okay, it's going to be uncertain. Let me just twist it a little, Deepak. I hope I'm not being unfair to you. Which is better for India? Is it better if we have a recession because that will mean crude prices will be under control? Or is it better for us that there is a roaring growth and a roaring inflation outside, more or less like we had in the earlier part of the current year? What suits India better?
Thank you, Lata, and thank you, Soumya and the SBI for inviting me. It's a real pleasure and a privilege to be here. I'm glad that I could dodge the question on projection. Somebody yesterday said that the economists were asked to make forecasts to make the weather person look good. So clearly, I'm glad that. So let's talk to the question about between the two Hobson's choice of having a global recession versus, say, raging inflation, as you put it. I think that's between, being between the devil and the deep blue sea. Which one is the choice that, India would prefer if I had to? So let me, at the cost of significant simplification, I think that a global recession and the way Sajid explained, which will be shallow and would be slightly better than a raging inflation for the following reason. I think a global recession will play out in the Indian context largely through the current account. So you have a decline in exports, increase in imports because India remains the fastest growing emerging market economy, and so larger trade balance and possibly higher current account deficit.
No, that is, you're saying a shallow recession plays to our advantage?
Yeah, so it will be current account negative, but I think it will be capital account positive. For the following reason that if you are expecting a global recession, that means the interest rates have peaked and have started to come down. There is no flight to safety, so the rupee is not under pressure. There's a lot more macro stability, and some of the capital would start to flow back because India is doing well. So if you have so I feel a shallow global recession would be negative on current account, positive on capital account, overall good, compared to a raising inflation, which I think would be negative on capital account for exactly the opposite reason. And for the current account, it depends on where is the source of this raising inflation. If it is largely fuel and fertilizer, that's again going to be negative on current account. So overall, I feel in the situation that you are describing, it will be less harmful for India if the world economy goes through a shallow recession than a very protracted inflation for the medium term. But can I just add a preface to this story that, we talk about this as if this is like a one-time choice that the India has to face. But the one thing is that 20 years ago, when a graduate student went to international finance course, we talked about something called a strong center and a weak periphery. That means there is this, the large advanced economies where the custodian of global macro stability. So there will be all this crisis in the periphery countries, but when it spreads, it will be absorbed by the core. Today, it is completely reversed. The last 5 global crises have all originated in the rich countries. Whether it's .com, whether it's LTCM, it's global financial crisis, whether it's the cost of living index, all of them came from there. And the emerging markets are the study, and they have adopted a lot of the good practices that used to be. So in a sense, this is a part of life now. For emerging, for the central bankers in emerging market, this is something that they have to live every day and not once in a decade, which used to be the case in the past. Thank you.
Yeah, I want to revisit that theme about our relative resilience versus the North Atlantic countries, if you please, actually becoming the source of the problems. But your point is that if it is a shallow recession, we would see capital flows come back. Just in the past couple of weeks, the fashion has changed. I mean, we were seeing a lot of capital flows. We've got negative FPI now for the last 4 or 5 days. And the themes are also changing, veering towards that. I heard it from Morgan Stanley and Goldman, singing the same theme. I don't know if others are also saying that actually North Asia will do better, that India is too expensive now. And as they expect, China will emerge from the COVID lockdowns, it would be more pro-North America, pro-North Asia. And you actually may see capital flows, or at least they are advising that those are the buy countries, the Koreas and the Taiwans, and maybe even the Singapores. But India is seen as sometimes underweight or even equal weight. We are not in the buy list for Goldman and Morgan. I wouldn't know about other countries. But clearly at the moment, the trend is not in capital flows, but I'm talking about a very small time period, a fashion that has begun only about a week ago. Soumya, let me come directly to the trade situation. This year, 6 months, we've only been discussing the rupee. And therefore, what are we likely to face if we have to be ready in 2023 on the current account and the capital account front? The October trade deficit numbers were not a pretty picture. The rate at which we have seen exports fall is scary. Imports fell, yes, from 60 billion, we came down to 56 billion, but almost entirely accounted for by the price of crude. So crude itself falling to $90 or $88 has not resolved the current account problem. It is actually keeping the current account problem pretty sticky. Will this be the run rate? I mean, 26, 27 billion trade deficit a month. And what are how do we get ready for that?
No, thank you, Lata. I think current account deficit is actually the external sector of India is turning out to be a very interesting proposition. If I all recollect, I think in July, we had one seminar where we attended in the RBI, I think, in Lonavala, and there the RBI forecast, I think that was below 3%, 2.8%. And at that point of time, all the entire market consensus, including we were expecting the current account deficit could actually breach 3.5%. Some estimates were close to 4%. But when the first quarter numbers were announced, and if you remember, the expectations were close to 3.6, 3.7%, the numbers came in at 2.8%. So there was actually an 80 basis point cushion and a positive surprise, even though if you remember, the first quarter was the worst hit in terms of the oil prices. After that, oil prices have started to moderate a little bit. We actually looked into this aspect very carefully, and when we did an analysis, actually in terms of some technical specification, we found out that remittances and software exports are actually acting as a very strong buffer, counter-cyclical buffer to this current account deficit deterioration because of the crude oil. And the results showed that if, for example, if suppose if the model, if the trends indicate us, and if the second quarter GDP numbers which are due on December 31st are actually close to 3.5% even, then even the full year number could be closer to 3%. So I don't know whether this will going to play out, but the second quarter service exports, as the RBI data shows, have already been very strong. Remittances has been strong, but the important point to note about remittances is that, I mean, it has been strong, but whether it remains like this, that is a matter of debate, because as rupee stabilizes, there is always a flavor that remittances could actually stabilize. But as of now, and for every dollar rupee depreciation, the software exports actually jumped by 250 million. So that was one of the results from model. So while I agree with the fact that this amount of trade deficit is unsustainable from a pure financing perspective, but if you actually look into these remittances and software exports, which has been very strong, that has acted as a very strong buffer in the first quarter. And if the second quarter numbers are to be believed, they could still continue to act that. If that is the case, we may escape this year with a deficit which may not be as high as was earlier anticipated.
I'm not convinced of that argument. I looked at the services exports and imports, and while I'm not able to put my finger at it, it doesn't reduce the current account deficit by as much as to bring it below 3.5%. When I calculated, I still got about $120 billion in terms of current account deficit. Sajid, are you as confident as Soumya?
So our forecasts, I think, are similar to the market, where you're about 3.5, 3.6%.
So that's $120 billion.
$125 billion. I think the IMF is there. But let's just analyze this on a more fundamental basis, right? The current account deficit is ultimately the investment savings gap of an economy, which is the investment saving gap of the public sector and the investment saving gap of the private sector. In other words, it's the consolidated fiscal deficit and the private sector investment saving gap. Now, in the pandemic, the deficit rose like it did all around the world, and yet the current account didn't move because the private sector offset it completely. Private savings went up because people couldn't spend, private investment came down. Now, the good news is the private sector is normalizing, and therefore, almost by construction, public sector investment savings gap is spilling over to the current account. So if we want the current account deficit to come down to sustainable levels over the next 12, 24 months, which it must in this global environment, you have to have a more fundamental corrective.
Which is bring down fiscal deficit?
Which is that you need to bring the fiscal deficit down. This way you can keep the private sector humming along. You want the private sector to grow. You want private investment to pick up, savings to go down, and to get an economic recovery. And for that to coexist with a sustainable current account deficit means you need to get consistent fiscal consolidation, which I think is very much part of the plan. I'm also a votary of the belief that apart from this income effect, price effects matter, that the real effective exchange rate over time does have an impact on the current account ex oil and gold. There's a lot of research that now shows that, including some work we've done. And frankly, we focus so much on dollar rupee. The real effective exchange rate this year has been flat. And to the extent that this terms of trade shock is a persistent adverse terms of trade shock, even if oil is at 85, it's still 25% higher than the pre-pandemic level or pre-war level. Some calibrated depreciation of the real effective exchange rate is not a bad thing. And I think the RBI, to its credit in the last couple of months, has been enabling that, because that becomes your shock absorber. I keep saying it's like wearing a seat belt in a fast-moving car. That if you suddenly brake, yes, you get a bit of a shock from the seat belt, which is your exchange rate, but you prevent greater damage. I'll make one last point. I think Deepak made an excellent point about capital flows. A lot of empirical work has found that one of the most important predictors of capital flows to emerging markets is the dollar index, the DXY. And the DXY has gone up in every single US recession strongly has strengthened, barring 2008, for specific reasons. So yes, if we look at a shallower recession, you will get less strengthening of the DXY, and that will mean that the prospect of capital flows coming into emerging markets will be better. But the current account is very much an idiosyncratic thing where we'll need to focus on the investment savings balance to make that sustainable.
Okay. Well, I just want to add two things. Let me let out a secret. I am part of a central banker's email group. One person is also in that group, and she is sitting here with us. And I learn a lot from that group. One of the things, when we go on harping about the strength of the DXY, our previous current account deficit problems or run on the rupee did not come only because the dollar was strong or weak. It came irrespective of that, our taper tantrum problem or previous episodes. So let us concentrate on housekeeping. Yes, the CAD is an independent problem. The strength of the dollar exacerbates or perhaps underplays, but it is not the core factor. Let's keep that in mind. I'm just saying, put it on the table. Let's not be too exuberant about how the dollar may strengthen or weaken. We have an inherent problem of our imports rising and our exports at the moment not doing too well. And your second point about this, we must allow a gentle depreciation. This is where actually two governors phoned and joked with me, Dr. Subbarao and Dr. Reddy. The one thing that RBI cannot do is a gentle depreciation of the rupee. The moment you know that a depreciation is on the cards, the market takes you to 85. But they don't let the RBI go from 81 to 81 and a half. Yeah. So they say gentle depreciation is very good as an intent, but it's not easy for the RBI to ensure that. It's a tough call for them to make. It's tough to implement, is what they were saying. It's more an ideal which economists talk about. For the central bank, are very tough to achieve.
No question, but I think the RBI has done a very good job since that September meeting. Exactly. Since September, it's now been 2 months. We haven't had excessive volatility. The rupee is weakened by 3%, and reserves are being used as they must. But you're using reserves to throw sand in the wheels, yes, not to protect the level. That's the only distinction to be made.
I'm not taking away I'm not taking away from it. I'm only saying that I hear a lot of economists report wanting a gentle depreciation. The central banker point of view is it's very easy to want it. It's not that easy to implement. Sorry.
I think they're underestimating themselves because they seem to have achieved it. No, it's gone from 75 to 83. And so the point I want to make about the current account deficit is that we cannot rely on any one instrument, whether it's switching the exchange rate or it's a demand compression or export promotion, import substitution, net zero and green.
Let me just drag you to, I wanted you to speak on that issue, but I'll just drag you to the theme that SBI has given us, getting India ready for the emerging challenge. I think we will agree that there is a likelihood of a current account deficit challenge continuing for the next 6 months or for the first 6 months of 2023. How should India get ready?
So, by using these multiple instruments, preparing all of this, certain long-run, export substitution, import substitution, export promotion, that is long-run. But in the short run, some switching, some depreciation, some raising repo rates, reducing demand, encouraging savings, reducing and so on. But also there's some positive things. When people say that savings have fallen, and we are waiting for banks to raise deposit rates, but what has happened is that financial savings have risen. And what matters for the current account deficit is financial savings, not physical savings. So we are seeing a switch in households. Our Indian problem is, one problem we have to solve is how to stop people holding so much gold. And, going into that adds to imports also. So the increase in the modernization or the development of the financial sector is helping our current account deficit problem. And in India, when I made that point about diversity, you always have some factors that are accommodating. Whether it's remittances flowing in after oil prices rise and so on, because of the sheer diversity, because sectors are not correlated with each other. So there is some automatic adjustment which happens, and then adjustment through the exchange rate, through reducing demand, and the other longer-term structural reforms are all acting towards, and then for financing short-term. If there's so much market worry about reserves falling, but we've seen some rise in reserves again. And then remember that we are in an age where it's very easy to arrange swap lines and so on. And eventually, I think the West should realize that the shocks have risen from there, as Deepak was saying, and emerging markets have been coping quite well. But you need some help, and there should be some sort of, international reserves available for this, swap lines. Emerging markets should be eligible, and there is talk going on about that. So there are a lot of resources available for the short term also.
Well, I'm not very confident that the emerged markets or the developed world is going to lend a helping hand very quickly in terms of swap lines. They have not been open to us, to the emerging economies. It's always been dollar, my currency, your problem. And it hasn't changed from the 1950s.
Yes, can I just add one more thing, which is that, we are seeing the markets reverse. Everybody was saying this problem is going to continue, it's going to continue for 2 years. Last 2 months, we saw money come back in. And it is true that the markets are so large now, the central bank cannot set the level. So if the rupee has depreciated much less than other currencies, it's also because there's internationally or among capital flow, whatever investors, there is a belief that Indian inflation is better, growth prospects are better, inflation is lower. And therefore, that it's a market you want to be in for the structural long-run story.
That's what they say, Ashima. But it's that we have to, $50 billion went out. We may look better, but Indonesia also has managed their, flows very well. And the global investor is not only looking at equity markets. He can go into other asset markets itself. So, I would still worry that the current account deficit problem is not yet closed. So, and dollar reserves are not just dependent on the Reserve Bank intervention, spending dollars. It's also dependent on the price of US bonds in which the reserves are invested. As the governor pointed out, the reserves fell. Only 30% of it was because of the dollars they sold. 60% was because the value of the bonds itself had fallen. And that's why the reserves looked lower. And all that will impinge on the market sentiment on where they take the rupee. Okay, one last word on the current account deficit, and I want to come to the fiscal deficit issue. Rajeshwari. So do you see that as an issue at all, and how do we prepare for it? Or like Ashima, you think it's not really that big an issue, and we will be able to chip in with other things?
So I have a very different perspective on this. I think the current account deficit is definitely a big problem. Is a problem. I think I'm not in the business of forecasting, but in general, I think 3.5, 4%, whatever percentage of GDP. But see, the thing is, current account deficit in and of itself is not a problem, provided there is sustained financing for the deficit. Yes. Australia is a country which has been running current account deficit for years without any problem because they get the funding. The problem is that we are running current account deficit high at a time when there's a lot of volatility about capital flows from all over the world. Now, irrespective of whether the US Fed is going to keep interest rate at 5 or 4.75%, let me give you a perspective. For the longest of time during our lifetime, the US interest rate was close to 0, 1%. Our interest rate on average was 5%, so roughly a gap of 4% simply in terms of interest rate. Now, if the Fed is keeping interest rate at 5%, that almost means will the RBI have to take it to 9% to maintain a similar interest rate differential? That's obviously not possible given our slowing growth prospect. So I think that there is a serious problem in finding adequate and sufficient and sustained financing for current account deficit at this juncture. And what is current account deficit is basically an imbalance of supply and demand. We are demanding way more dollars than what we have. How do you resolve that current account deficit imbalance? Either you stop demanding so much dollars, which is difficult because our imports are price inelastic largely, or you increase the supply of dollars. Either you increase your exports, which will take time, or you let the exchange rate go. I don't particularly believe in calibrated depreciation or gentle depreciation because I don't think once you've opened up your capital account and there is open trade, you can't really control a price. At some point of time, the price will start responding to market forces. And the more you try to put a lid on it, the more the pressure will just ooze out from all sides. So I think the only way to deal with the current account deficit is you let the rupee go because there is some price at which government bonds, Indian assets become attractive for foreign investors. And that's the way the correction happens. Your Indian assets become cheaper in terms of dollars. FIIs come in because there is an expected appreciation. And as they come in because the Indian assets have become attractive, the rupee starts bouncing back as well. But if we try to tinker with the value of the rupee, we sort of let go of that automatic correction mechanism of the market. And simultaneously, in the best case scenario, US has a slow growth, EU goes into recession, exports will be flat for emerging markets. With the growth that emerging markets have just as an inertia, there's going to be a current account deficit pressure no matter what. So you're going to be doing this constant toggling between how much to let the exchange rate depreciate or not. And I really don't think that's going to help solve the problem, considering increasing exports is not something that's going to happen over the next 1 year.
Well, that's leading me to one of my, what do you call that? Rapid fire question. All of you have to give me a number. Average dollar rupee for the first half, Jan, June, and average dollar rupee, June to December, 2023. Shaumya, you go.
Difficult to say.
Only two numbers. No sentences, two numbers. Range is allowed.
Maybe 80 to 82 in the first quarter of next year, or 79 to 81
In the
first quarter, 23. And
second half?
not much difference, maybe 80 to 82 something.
So it doesn't go beyond 82, you think?
No, I don't think so as of now.
Okay. Sajid? You thought I'll come last.
It's an impossible question because, as I said, it's a function of the DXY. So I'll make mine conditional.
I'm sure JPM has something.
And
Tell me what
thankfully,
your-
I don't have to make that forecast. Conditional on the DXY being range bound in the first 6 months of the year, given what I said, 82, 83.
Okay.
If the DXY strengthens as you get closer to a US recession, given what our DXY forecast is, probably 83 to 85. Right? So relatively benign, given what the global outlook is.
Okay. Actually, this is becoming a foul. Huh? I told y'all I want numbers. And I'm getting sentences. Ashima?
Keep this question for the forecasters, but I think I agree that in this H1 it will depreciate a bit, say 83, but it will strengthen after that. Because some research we've done suggests that when you look at structural factors, India's real exchange rate is appreciating. So those should take the market back after all this volatility subsides.
Okay. So better off in the second half. That's qualitatively helpful.
I think the answer depends on what do I get if I end up forecasting right and what do I lose if I end up forecasting wrong.
First two forecasts, I'll tell you what you'll get.
So as I said, I'm absolutely not in the business of forecasting. And but since I've been put in the hot chair, I think if the RBI does not intervene in the foreign exchange market, and that's a very big if, it could go up to 84, 85. And that's where I'll stop, because it's impossible to forecast the price of anything. It's just that I can't forecast the price of any commodity and service.
So you think the pressure is on in the first half?
Definitely so. I mean, as I said, there's a lot of uncertainty about what the US Fed and what EU is going to do. Okay. And I don't think we can even predict beyond March or beyond February.
It's just taught me that I should not ask single word answers. Your answer, you're not going to vote at all. Okay.
I think I'll go with Sajid.
Okay. That is?
80 to 85.
80 to 85. Okay. So the pressure is on. I mean, I guess there are bankers and industrialists here who really want to know that answer. But now let me come to the fiscal deficit. Ashima, you know, as Shaumya pointed out, and I guess even Sajid said, the fiscal deficit pressure is there on the current account deficit. I mean, the more dissaving, the more there is this pressure for the rupee to depreciate or the current account deficit to widen. What would you expect from the budget? Do you want them to go down at least 50 basis points in terms of fiscal deficit? Is that an absolute, Lakshman Rekha, that the fiscal deficit has to go to that 4.5 in FY26? And on the way to that, if you have to get to 4.5 in FY26, we are talking about 210 basis points reduction from 6.4. So 70 basis, is that a non-negotiable minimum?
I don't think you can negotiate anything in politics, but I think that India's tax buoyancy, higher nominal GDP growth, all of that suggests that it is highly feasible, whatever the demands in subsidies, etc. And the other thing, as I said, that the fiscal policy has been very intelligent and adapted to Indian conditions in the sense that the intervention in the food economy has helped with inflation in this period of the Ukraine war when food and oil, and raising oil taxes when oil prices crashed. So now there was room to lower it. So that this cost the fisc some, but it reduced inflation and allowed real rates to stay low. I've been writing, and I think that snowball effect. In emerging markets, you have much higher growth rates. Now, if your G is greater than your R, that is your real interest rate, then the denominator is rising and the deficit, debt ratios, everything comes down. So as long as we can prevent too much volatility, that's why I don't agree with Rajeshwari, let the rupee go, let the interest rate go, and so on. Because there's too much volatility then, and we've suffered from that over the last decade. So as long as growth is greater than R, there's not too much volatility in R, therefore not too much volatility in exchange rates. That is going to bring down deficits and debt. So this 2% reduction, whatever it is highly doable. And that puts India in a very good position because fiscal consolidation in today's environment, we had a lot of analysts during the pandemic saying, follow the US, spend more, fiscals should spend more. And now those same people are saying fiscal consolidation, right? But we are in a position to do that, to have that fiscal consolidation happen normally, gradually. Yeah?
No, actually, we also have to face the harsh truth that in, in the rating agencies bracket of BBB minus where we are the worst in terms of fiscal deficit and current account deficit. The only reason why we are in that category is that we have the growth to back it up, which others don't have.
So that risk premium comes down, if your rates are smooth, if there's not too much real volatility.
Yeah. So, we must be conscious that we are getting the rating in spite of very high fiscal deficit compared to the category we are in.
Yes, emerging markets. So we need to consolidate, but higher growth and lower interest rates should that happen.
Yeah, and actually I want to come to that. On Soumya, to you. We have been surprised by extraordinarily good tax performance. I would assume that, I think I've read many of your reports, and probably you're going to see corporate taxes, come down, that kitty, because we could see in Q2 itself, margins are taking away a lot of the EBITDA. EBITDA has grown much lower than revenue has grown. Top line's excellent, I think 30% or something, but you can't say, I think it's 8% or something EBITDA. So, would you say that we can have this kind of a tax growth, this buoyancy in the subsequent years as well? Is that a structural shift in India, the higher taxes?
No, I think in terms of the deficit, if I remember correctly, some numbers came, 4 trillion is the excess estimates the government is expecting in terms of the tax collection. I think that's a big number. And
3 trillion more.
4 trillion, I think.
4 trillion
4
more.
trillion they're expecting than the budget estimates. So I think if that materializes, that's a big number, and that could actually keep the fiscal deficit at almost the same level government has budgeted, in spite of the significant increase in expenditures because of the wars. Now, having said that, there are two things over here. The positive thing is that India is perhaps the only country where the tax to GDP ratio has increased during the pandemic. I remember that peak.
No.
Yes.
I am absolutely sure that in many of the US states,
this number is with me.
Reported surplus, Soumya.
India's tax to GDP.
That we are not the only ones. Somewhere else also tax to GDP rose.
No, I'll tell you, India's peak tax to GDP ratio was 12.1% in 2008. And it has declined after the 2019, if you remember the changes in the 5 lakh one. It started to increase, now it's close to 11%, it's 10.8, the center. The states, if you add another 6, that brings to 17.8. Having said that, the problem is because of the enormous numbers in, next year. Next year, if you know, total redemption of the government, the borrowings is 4 trillion. So that is number that could actually take the government borrowing number to gross borrowing to anywhere beyond what is today. If that is the case, and if you're looking at such a significant amount of redemption, so basically the gross borrowing could go higher, I think the pressure will remain. And please remember that next year is an year before the elections. So it will be a very tightrope walk on the part of the government. Of course, the government will set for a fiscal deficit target lower than 6% to stay on the path of fiscal consolidation. But given these huge pressures on the redemption, because this will go up. In the next couple of years, these numbers could go up even further. The gross
It was
borrowings
switching,
could,
no?
yes, the gross borrowings could be higher. The government has to come to innovative way, but that will keep up the pressure on the debt market. Debt market is actually, I mean, very surprisingly, debt markets rates have been anchored at below 7.5%. Even all of us, everybody was expecting the rates could go to 8%. That has been significant anchoring. Large part could go to the RBI, and also because of the, I mean, several other reasons. But I think that this pressure is going to be there, though we are on the path of fiscal consolidation. But the good thing is
you're
that
saying we can bank on higher tax
yes,
buoyancy
we can
next
bank
year
on
as
tax
well.
collections, but as we move on to the next couple of years, as huge amount of redemption comes in, the government gross borrowing automatically will go up.
Fair
So that's something which we need to watch out for.
Yeah. Would you say, therefore, that 5.7, what should the budget say?
I think the budget will try to bring it below 6%.
Below 6.
But if you not, I mean, but I don't think they will go too ambitious on the target because they know that it's an election year. So therefore, they have to, I mean, be reasonable in their assumptions. Because in any case, I mean, every year you can't have a tax collection which is higher than 4
So
trillion.
sub 6 is one way of preparing for next year. Rajeshwari, you wanted to add?
So one thing I wanted to add is that I think in the budget session, there'll be a lot of pressure on the government to do more capex announcement or more expansionary measures because there is a fear that facing global headwinds, Indian growth is going to slow down significantly. And considering the private sector investment has been sluggish for a very long time, there'll be a lot of expectation that the government needs to step up even more. And that is a temptation that I think the government needs to avoid because there is literally no fiscal room to do any further expansion. You know, after Ronald Reagan did his tax cuts in the US, for 20 years, the US followed one fiscal policy, which was reduction of fiscal deficit. I think that's pretty much where we are at, that we need to reduce the fiscal deficit consistently for a period of time, because by any emerging market standard, a debt to GDP ratio of 90% is very high and worrisome. And as Shoma mentioned, that one repercussion of high fiscal deficit that we don't always observe is that it actually has a direct impact on monetary policy. Not because it leads to inflation, but because there's a lot of pressure then on the central bank to manage the bond deals so that the government's cost of borrowing does not go up. And that can interfere with the conduct of monetary policy at a time when we are still not out of the woods as regard as inflation is concerned. So I think to that extent, fiscal consolidation is something that we need to take very seriously. Although I admit, I think the FRBM Act is something that needs to be revived in all its form. But yeah, that is something that I think we should be very serious about.
Yeah, actually, tax was the positive surprise, but the huge negative surprise is that we have not gone anywhere in terms of divestment. That didn't come. And of course, other non-tax receipts have also been subpar. I mean, oil company dividends will not come because we've used part of that elbow room for keeping inflation down by keeping the oil prices more palatable. You wanted to add anything on the fisc? No, we can hear you. Go ahead.
Just a 1 minute intervention. So, you know, if you look at the reason why today India is so resilient is because we had built these policy institutions to take care of the macro stability, and one of them was the fiscal responsibility bill, the other is the inflation targeting. So I think it's paramount that India should try to come back and build this reputation on those. So I would be very aggressive in saying to the finance minister and others that they should try to come back to the 4.5% target as soon as possible. If that's, you know, and the fact that if you look at the Indian history of 20 years, India has never achieved low deficit to GDP by cutting down the numerator. It's always the denominator increase. And we have a situation today which would actually facilitate that. So I think I would be much more aggressive to reassert the macro primacy and the macro stability in the discussion.
No, I completely take your point. That's very valuable. Institutions like inflation targeting, institutions like the FRBM, institutions like an RBI, all these have definitely helped in keeping the macro balance, and everybody has respected that. No taking away from that. Ashima, I just wanted to add, this point is coming back to me. Is this tax buoyancy something everyone has seen because you've come from very low levels? There has been informal sector giving way to formal sector in many countries, other countries as well. Small giving way to the big, the guys who pay the taxes. I mean, do you realize that we don't see so many chanawalas anymore? And in many of the I don't know if you'll travel by trains, I travel by the local train a lot, you get Haldiram's peanuts. You don't get the chana wala. That's a 10 rupee packet, you know, the Haldirams. So clearly there is a formal sector takeover of informal. So anyway, the short question to you is, do you think we are in a secular rise in taxes, or is it just the early cycle business cycle rise which is giving us more taxes?
No, I definitely think it is a secular rise because we've had a lot of tax reform. Remember, GST was such a big reform, and that is quite buoyant now. And I would like to put it as that small guy is growing big, you know, rather than the small guys being taken over.
Not so sure of that, because I want to come back with a question on that.
Anand had a very nice presentation, you know, on MSMEs. Thing is, with MSMEs, you don't get data. So you get anecdotes, and anecdotes can vary because there's a lot of heterogeneity. But you hear a lot of positive stories. This you know, the...
I will play devil's advocate on that, but I want to finish this formalization question, one more, and then come to that K-shaped part of the economy. And I think Pavitra will already warn me that I'm overshooting time. So very quick questions. I'll tell you where, I want to ask all of you, bankers and economists, you know, when we got that 16.6 lakh crore fiscal deficit and 12 lakh crore borrowing number on February 1st, remember how adversely the bond market reacted on February 1st? Actually, the borrowing has not been such a heartbreak at all. It's been a reasonably smooth panning out, with the Reserve Bank not having to manage the yield curve at all. Yield curve as a public good was last year. This year, the RBI has not been at the stands much. And one big reason which I just discovered in an RBI seminar is that insurance companies have been big buyers, and how, because of the way in which the interest rates have gone up, they have sold a lot of guaranteed products, and therefore for the next 2 years they have done hedges, which is like, you know, FRA agreements, forward rate agreements. And I'm given to understand a data I picked up when I was preparing for this panel, about nearly 2 lakh crore of bonds they have purchased, they're warehoused for the insurance companies. I don't know if my number is right, but that's what I got from the market. Do you think that's a structural shift?
Lata, a couple of things, you're right.
Demand from insurers, pension and others.
We need to be careful out there because you're right. I think there were two factors. One was insurance demand. The second was state borrowing was much lower than what was worried, and that both helped the bond market. Let's just step back. Clearly, there are some structural elements to this. If you look at GST collections, a lot of it is because of improved compliance. For example, it's gone from about 6.1% of GDP to 6.7%. And one can expect that this is just going to keep rising with time to come. But the bigger question is this. Over the next 3 years, we have to bring the deficit down by 2% of GDP, whatever the distribution is across 3 years. Now, what we don't want to do is forego or slash things on the expenditure side, right? I think one of the most important things the government has done is push up CapEx. CapEx used to be 1.5% of GDP. It's now 2.8 or 3% of GDP. So the challenge is, how do you bring the deficit down by 2% of GDP and maintain and actually increase CapEx and accommodate other demands, more health money or more education money? It has to be revenue mobilization. Some of it may have to be asset monetization, but some of it has to be more tax reform. What is that? The next stage of GST rationalization, right? Rationalize slabs. The revenue neutral rate is still 4 percentage points than it was below than was the pre-GST. And personal tax reform. We should do on personal taxes, not now, but in the next 12, 24 months. What we did on corporate taxes, essentially, is take away the exemptions. So effective rates and notional rates don't change. So there's a lot of stuff we have to do on the revenue side to ensure that you can do both things. Consolidate without hurting growth and actually keeping up CapEx. One last comment. We've spent a lot of time on the next 12 months. I think you have to look at India in 3 horizons. The next 9 to 12 months have to be exactly what Deepak said. Focus on macroeconomic stability, current account deficit, inflation. But actually there's some light at the end of the tunnel. If you look at the next 2-3 years, for the first time we haven't discussed in a 1-hour seminar the twin balance sheet problem because it's gone away. Corporate debt to GDP is the lowest since 2006. Bank balance sheets are much cleaner. So there's actually a prospect here that 2 years from now, on the other side of this cycle, when the global economy is recovering, rates are going down, if utilization rates in manufacturing actually pick up from 75 upwards of 80, if macro uncertainty goes away, we might see the starting point of a capex cycle after a decade. So let's be clear what the priorities are. 9 to 12 months,
CapEx cycle after a decade? I thought we already started, no?
Well, we need to be careful. I think, let's be realistic. At a time where everybody's worried about a global recession, and interest rates are going up around the world, and utilization rates are at 75, you'll get episodic capex in sectors. But to expect a broad-based cycle when the whole world is turning around is unlikely, and you will have to wait 2 years. But the fact that we're talking about it, that the preconditions are in place, that the supply side constraints have gone away, I think is huge. So I think there's a 12-month macro stability, 3-year capex cycle, and a 5 to 7-year horizon to capture the China plus one opportunity. And being clear-headed about what your objectives are across time horizons, I think, is important.
No, I take your point that, the big point you're making for making India ready for next year's challenges would be indirect tax, GST consolidation, and personal tax. Okay, this we speak about every time, giving away the exemptions and bringing the slab down, but it's not something that's been that easy. We have not been able to deliver. We have delivered much less on what we are all very proud of, the capex cycle. Budget estimates are always very good. When you get the RE, it is lower. When you get the actuals, which no one reports, because it comes, by the time it's May, you get the
But the
March
first
actuals.
8 months of this year, if you look at the CGA data, they've kept to capex targets.
I agree with you completely. I have seen this in the past. Because I report ticker by ticker, I'm telling you that we don't report the actuals at all. And actuals don't often come up to BE anywhere near it. Let's hope we do it this time. I mean, I agree with you. And anyway, state capex has to take off. State capex is twice the amount that central capex is. And over there, the expenditure bandwidth has been wanting. The center has been doing very well in terms of trying to goad, but we have yet to see the results. Though, the manufacturers are saying that in November, they have seen much more state government orders. I think we are coming to the close of our discussion. The next discussions are ready. Can I get one rapid round? Please, let's make it rapid. One in terms of getting India ready. Soumya, what would be the one big thing you would want government, RBI, any of the policy makers to do to make India ready for next year? One big reform or policy step, anything.
No policy changes, no abrupt policy changes in taxation.
No abrupt policy changes in taxation. Thank you very much for that. Deepak, can I twist it a bit for you? Since I think you, Sajid and all are also in the G20 discussions, since India is, taken the presidency. Would you say getting India future ready, something from that angle, somewhere where we can use the G20? I don't know if I've stolen your thunder on this. No, you're free to give us 2 suggestions.
I think Mr. Kant made a lot of interesting points yesterday in the evening. He talked about, I think, 3 priorities that are relevant for this discussion. One was this whole dealing with the debt crisis in emerging market. I think he wants India to take some leadership role on that. I think there was a discussion that multilateral
That was a good
reforms,
point, only it doesn't dovetail with making India ready for next year. So anything that you should think India should or should not do?
No, I thought the answer that I wanted to give to your question was that I think we just need the government to trust the private sector more. I still feel there's a mindset issue that there is still too much regulation and there are too much doubts, and I think we just need, if you really want to be like the Vietnam and China and countries to grow rapidly and private sector be the engine of growth, I feel we really need to liberate the private sector a lot more.
Absolutely. I mean, that would be a motherhood for many years now, that we need to be having less suspicious legislation, criminalization of penalties, where civil penalties should be more than enough. Rajeshwari.
Can I make 2 points?
Sure.
So one is...
Even 3 is allowed.
Okay,
but
great.
They should be making India future ready.
So one thing that I want to be a bit cautious about is when we say that the financial sector balance sheet is healthy, I think the perspective there is, if I just look at the banking sector, and this would be very well known to the audience here, there has been a bit of a structural change over the last 10 years. The share of industrial credit in total bank credit has come down from 46% to 28% over the last 10 years. The share of consumer credit has gone up from 18% to 30%. So what is underway is a silent consumerization of bank credit. So while not having the twin balance sheet is a great welcome, but the flip side of that is basically there is no demand for bank credit from the industrial sector, and there is no supply of bank credit for the industrial sector because of heightened risk aversion from both sides. So I think we should take that with a pinch of salt, that the credit growth that we are seeing is essentially in the retail consumer sector, whereas what we need for growth also is private investment, as Deepak mentioned, and there is a chicken and egg problem. The private capex cycle isn't really taking off because of risk aversion, and then there is a funding issue as well because the banking sector supply of industrial credit has gone down significantly. So on the formalization point, which is tied to what I'm saying here, is what has happened during the pandemic is that a handful of 200, 300 firms have done very well. They have grabbed market share at the expense of the larger number of smaller and medium-sized firms. So they are doing really well. And many of them can also access the bond market because they are AA, AAA rated. But for the larger mass of the enterprises who should be doing the job creation, there is neither credit nor is there any activity because of risk aversion. And I'll just leave you with one number in terms of getting India ready. Since 2015, the total number of people employed in the workforce has remained stagnant at 400 million. There has not been a secular growth in that number since 2015, be it pre-pandemic, be it post-pandemic now. And I think that is what would worry me the most in terms of getting India ready for any challenge, because if you're not going to create the jobs, we are not going to get the growth that is required either for tax buoyancy or for meeting any kind of global headwinds that we may be faced with. So that's basically what I wanted to say. So in terms of one last point, what India needs to do, two major drivers of growth for an emerging market like India are private sector investment and exports. Investment, I think we've beaten our heads and nothing really seems to be moving. The capex cycle is only slightly turning now, but I don't think given the uncertainty globally, there's going to be any big improvement there. I think one thing that we need to do perceptibly is reduce import tariffs, make India much more export friendly, because despite the global slowdown, there is huge potential for India because India's share of global trade is very small. And China has been withdrawing from the global landscape of trade for quite some time. So there is a vacuum, there's a gap that can be filled up, which countries like Vietnam, Philippines, and Bangladesh are coming into. So I think we need to be conveying to the world that we are much more export ready by reducing import tariffs, by reducing import taxes, which should be matched with export subsidies. But currently we are doing both export subsidy and import tariff, which is a bit of a contradiction in my mind. So I think export orientation of the economy is something that we should definitely focus on, which might also trickle back into private investment over a period of time. Thank you.
We require a whole session for that, or many sessions. I mean, it's a huge topic. I was actually going to finish the round of suggestions, but I'm going to come back to you all for the suggestions in a minute, because I think we didn't handle the issue of the K-shaped recovery that Rajeshwari is speaking to. Ashima, you said that there is anecdotal evidence of MSMEs doing well. I'll give you anecdotal evidence of this K-shaped recovery really coming home to roost, especially in the second quarter numbers. Every FMCG company has announced low single-digit growth in volume. Every one of them have said that premiumization is the theme. Premium products doing well, mass products not doing well, including two-wheelers. Entry-level segment, there were companies which said, I would like to think that segment doesn't exist for me because it makes me so depressed. But the premium bikes doing well. Can we get to, is this one of the challenges that may hit us, that there are not enough people transiting from the lower middle class to the middle class, or from the lower class to the lower middle class, and therefore there is a very skewed growth, and that hits the pace of growth also. Is that a possible challenge? And that question to both of you.
Right. I think that we look at India's history, we've not been able to have large-scale manufacturing employment, and that's required given our population size. So now, when people say why corporate tax cuts and so on, the idea is that, or get into these global value chains. So that is one way in which you're trying to increase labor-intensive manufacturing. Then you're encouraging a lot of non-agricultural rural business, which is also creating, we are seeing a lot of exports in high horticultural products, honey, etc., which is creating income for farmers. And then the third is entrepreneurship. You're seeing a lot of young people, the outsourcing. You know, you talk about the exchange rate encouraging software
we
export.
are underway into
These are the
correcting
strategies. Because, you know, other things have not worked. So let us try this.
Has this worked? I'll tell you, the last few months'
But
data.
we are just after a pandemic, no? So give it some time.
No, I agree with you. What hurt me about the October data, again, I'm speaking about 1 month, which is very foolish. But, you know, what's hit? Ready-made garments, textiles, man-made and cotton, made-ups, fabs. All these are extremely labor-intensive. Those were the ones that have gotten knocked first. So, I mean, do you think that would be for the future-ready India? Is that something we're addressing enough?
Yeah, so that is why, you know, in the MPC, for example, you need to pay attention to growth as well as inflation.
Oh, yay.
To make sure that jobs are created for people everywhere.
Okay.
And so it is multiple efforts across multiple fronts which will work. Yeah?
Okay.
So give it some time.
Okay, so the MPC must concentrate on growth as well. The minutes are getting echoed here. Yeah, go ahead.
Yeah, so you want me to respond on that last?
Mainly that the measure, no, I'll come to that. Just this K-shaped recovery and whether it might stymie our pace of growth.
Lata,
I mean, is it a reality we have a K-shaped recovery?
What we've seen
Will it
around
stymie growth?
what we've seen around the world, not just India and emerging markets, is this was a very Darwinian event, survival of the fittest. The formal sector did increase its market share around the world and therefore had more pricing power, for example. So what this does is it kind of compounds the age-old challenge for India, that in a very favorable demographic environment, you have to create lots of blue-collar jobs. Now, I'll just give a couple of points to reinforce what Rajeshwari said and Ashima said. We need to create those jobs over the next decade, we need 7, 8, 9% growth. No country, for a decade, no country in the world has grown at 8 or 9% without strong export growth. So if you ask me what has to be the overarching policy prioritization, how do we increase global export share? That can only happen if we integrate ourselves into global value chains. There has never been a more favorable outlook for India geopolitically. If you add China +1 and French shoring and the lesser known fact, the unskilled, low-skilled, labor-intensive part of the global export share, China is vacating huge amounts of space. Textiles, leather, gems and jewelry, ceramics, furniture, they have vacated massive amounts of space. This is India's comparative advantage. It is our moment to fill it in the next 10 years. So we need a policy setup which is complementary, trade facilitation, free trade agreements, tariff rationalization, exchange rate, infrastructure, regulation, all aimed at one thing. How do we fill this huge gap that China is leaving? Because this happens once in a lifetime, once in several decades. That labor-intensive export focus will create the blue-collar jobs that was a challenge in the pandemic.
I guess PLI was intended there, but we have to get 10x there. Ashima, your one measure for...
One measure only?
No, you're allowed 10.
Okay. No, I'll keep them very short. One is that being in the G20 and this opportunity, there should be a lot of international money coming. You know, we say international rates are low, investment is not taking place. So investment for net zero. You know, leverage this money. Our financial sectors should play, our banks should play a role there. Get this money from outside and spread it through the economy. The second is that we want investment to increase public investment, but at the state level. So what is going to help there? You need something, I was reading that sits, you know, like NITI, Institutes for State Transformation are being set up as NITI clones. So you can really improve the way money is spent. And it's, like I think the center has done this, appreciably larger amount for infrastructure. States similarly can do a lot of restructuring in the expenditure, simplify regulations, etc., invite private investment. So these are the measures where big difference can be.
I would request SBI to have a seminar. I shouldn't wait till next year. How do you make states spend? I mean, we've reached a stage where states are not reaching their capex levels. They have enough money to even lend in the money market. It's reached that stage, states like Maharashtra. So how do you increase spending bandwidth is perhaps something we need to ponder on what's holding back. This is the time to throw open questions to the audience. I don't know how much time we have. Please let me know. But I'm going to start with a question to the audience rather than the other way around. Mr. Khara, Rajeshwari spoke about this consumerization of loans. But only in the second quarter, I actually noted that most of the corporates, most of the banks have shown an uptick in corporate loaning as well. I saw it, I think, in SBI, HDFC Bank, and several others. I mean, retail credit, while it is still the larger share, between Q1 and Q2, corporate loan growth has picked up. Sir, if you can enlighten us on whether this is a secular trend, how do you see corporate loan demand?
No, I think there are a couple of reasons why we have seen this kind of a corporate loan growth. And in fact, this growth has been the highest as compared to any other segment. It was as high as about 21%. And it is essentially attributed to the fact that the money overseas has become costly. And even whatever used to be raised from the CPs, even they have become costly. So they have started coming to the loan market for availing that kind of a loan. The other question, which was essentially coming from the consumerization, I think that's a reality, but still, if at all we will look at the leverage on the individual balance sheet, it is still much lower. And I think there's a huge demand, which is pent-up demand more so post-COVID. So that's why we have seen a very secular trend in terms of the retail credit growing for almost at about 16% per annum on a CAGR basis for last 4 years. So that is, I believe that it will continue to be a mainstay for the lending in the banking sector. But nevertheless, we have started seeing traction in the corporate as well as into the SME sector also.
That's good to hear. One doesn't know whether it's only started, or as you point out, it's only a changeover from borrowing from the market to borrowing from banks. Pavitra has to tell me how many questions I can take, but please start.
Good evening. I have 2 questions for the panel. In order to make India ready, the space being vacated by China, are we going to focus on the MSMEs, and do we feel that these are going to help us do it? Or should we look at big companies coming and getting that space? That is number 1 question. Second is, we are talking about getting India ready. Should the PLI be based on investment, or should it be based on job creation?
Okay, good questions. Well, anybody willing to? Yeah, Rajeshwari, go ahead.
So I think...
Rely on MSME or big corporates?
So I think it should be both. I don't think we can just say that only the MSMEs or only the big corporate. At this point, the idea should be for India to capture, as Sajid mentioned very nicely, that this is almost like a historic opportunity for India, but China had faced in the early 2000s. And it's up to us whether we can capitalize that opportunity in the global value chains. Now, irrespective of whether the MSMEs would do it or the big corporates would do it, I'm not so much in favor of the government or the state deciding which sector gets to export or which sector gets the subsidy or which sector gets the benefit. I think the job of the government should be to create a conducive policy environment, and then the private sector, be it the MSMEs or the big corporates, can leverage that and decide whether it's beneficial and profitable for them to start exporting and be a part of the global value chain. So but having said that, I think the MSME sector is a sector that can create all the jobs that we need, and that is the sector, thankfully, because of the ECLGS credit guarantee scheme, is now getting a lot of credit. But there has to be much deeper policy thinking about how can we ensure that that sector starts exporting and start employing a lot more. Because, remind you, they have been very badly impacted by a series of shocks, demonetization, GST, pandemic, and they are the ones who should be able to create employment and do exporting.
Okay, well, Soumya, you want to take the question?
Yeah, can I just say one phrase? Yeah. Investment or employment? I would say investment for employment.
Okay. Yeah, but how do you design the policy? Should you get the subsidy if you put in so much money as investment, or you get the money if you put in so much money and you create so many jobs?
No, let it be a commercial decision. You set up this PLI, which is encouraging investment, which should create large-scale employment.
I'll give subsidy for what? For money or for jobs?
I don't want to just create jobs which are not productive or commercial. So let them take the decision. But you encourage investment and perhaps, labor-intensive sectors.
Gets more points. Yeah. Okay. Shall we want to take that? PLI for not just, you don't get the money only if you put in the investments, but you have to show how many jobs you've created.
Yeah, no, I think the MSME sector, just want to add one point on the MSME sector. Of the total credit growth in the banking system this year, more than 10% incremental is contributed by the MSME. So it has actually turned out to be much better. And we all talked about a K-shaped recovery, but I could actually go beyond it and say it may not be the K we had actually initially looked into. The lower part of the K could be a little more better than what was earlier anticipated, because the MSME sector has really done well if you look into the corporate bank balance sheets in terms of all restructuring, other advances. So that has been the most important surprise recently.
That's very good news. That's definitely good news. Yes, sir.
Good evening, madam. In recent news coverage, you have seen that government is giving 75,000 appointment letters, and they have the target of giving employment letters of 10 lakhs. Don't you think?
We can't get your question. Maybe you want to come. There is a problem in terms of acoustics. No, go ahead. The mic is working fine. If you could just repeat your question slowly. Yes. What is your pointed question?
In the recent news coverage, you have seen that government has given appointment letter of 75,000, and they are going to have a target of 10 lakhs. And when we have a deficit financing and in the budget, it is going to increase the expenditure. Don't you think that instead of giving these employment letters, private sector should be given opportunity to give the employment, which will be more useful for the general economy?
I just want to say, if anyone is willing to take the question, fine. Sajid, Soumya, anyone willing to take. I just wanted to say that, the letters were, even if it reached 10 lakh, it would only be the number of vacancies that already existed. Government is not spending more. So that itself is not leading to extra deficit financing.
Madam, let me say, I am a government officer, and in my department, there is 50% vacancy. And still we are doing the same work. When you fill up that 50%, then the expenditure on the government will increase, definitely. Then where the money will go for developmental work?
I think this is too large a question. Anyone wants to?
Can I take it? I think it's a very good point. What he's saying is that the effort to create jobs in public sector for the sake of creating jobs, I think is a terrible idea, which I think I agree.
Yeah.
I think, you got to let the private sector create a job and create the environment for it. I think the idea that you should link incentive to creation of job is also not a great idea. I think, so ideally, a lot of these incentives should be output-based and market-driven, like exports and something of that sort. So
fair enough.
Yes, Deepak, that was the idea.
Okay. That could be debated. It's a great question, sir, but it would require a whole panel, and Pavitra is already on her stand. Thank you very much, Soumya, Deepak, Rajeshwari, Ashima, and Sajid.
Lata, thank you, and thank you to all of our panelists for that wonderful discussion. Even though, Lata, you really hid behind me for overshooting on time. But one final time, if I can call Mr. Khara here to please give away the mementos.
Finish your call. I'm sure this is national interest. We can wait.
I serve the nation always.
All right, so it has been 2 days of stimulating discussions on the most relevant issues that face us today. It is now time to wind down on the 9th edition of the SBI Banking and Economics Conclave. I do hope that the ideas and debates will stay with you for a long time to come. But for one final vote of thanks, may I please call upon Ms. Saloni Narayan, Deputy Managing Director of Finance at the State Bank of India, for this vote of thanks.
People have already left. Good evening, everybody. I know it's been a very long day. Finally, this brings us to the end of the second day's proceedings, and it's my privilege to give the final vote of thanks and to summarize the overall event. The second day has been as exciting as the first, and we started with the address by Shri C.S. Sethi, MD, IB, GM, and T, who summed up the proceedings of day one and made my job easier. I will now sum up today's proceedings. We started the day with the ESG panel discussion. This panel covered a large turf on the accomplishments and evolving opportunities in the ESG space. India is already ahead of the curve and has walked the talk when most of the nations are still on the drawing board. As a bank, SBI has been at the forefront, internalizing the ESG, and it will be some time before ESG will enter underwriting decisions. We will have to be mindful of greenwashing, and there is need to develop market for carbon trading and framework for creating offsets and an Indian taxonomy. The address by Deputy Governor Dr. Patra was a refreshing insight on the lighter side of monetary policy. The session introduced us to the unknown subject, the humorous side of monetary policy making. Monetary policy was opaque in the 1970s in terms of communication, and now it is all about communication itself. One of the most important points which the Deputy Governor emphasized is that the monetary policy, though it is forward-looking, it works on data that are dated. So by that logic, if the data is dated and revised later, then why not the central banks also have the freedom to revise the monetary policy decision? This is a serious food for thought. The panel on manufacturing and services sector talked about the significant formalization that India is undergoing. There's a definite shift of savings to mutual fund and equity market. Domestic savings is dwarfing the formal flows. Manufacturing is facing problems of high import costs. However, services export is doing well, giving comfort to our current account deficit. Creating jobs in manufacturing is as essential in the coming years. SEBI is trying to ensure sustainable capital formation. What is important today is to increase the share of manufacturing exports, which has stagnated at around 2%. This requires looking at services and manufacturing as a package rather than in isolation. India is expected to be amongst the top league, achieving a cost reduction from 13% to 8% in logistics sector, owing to various initiatives of the government. The panel also highlighted that India should learn from other countries like Vietnam and others, which have signed various trade agreements with countries like EU. The group chief economic advisor, Dr. Nageswaran, gave us insight into the current economic situation. He emphasized that the world is facing polycrisis. However, India is one of the fastest growing major economies due to rebounding private consumption and consumer sentiments. Indian economy is showing signs of recovery. Investment cycle is going to recover due to conducive economic conditions. Corporate and bank balance sheets are well capitalized, and there is enough appetite for lending and borrowing. Public capex crowds in private capex. Furthermore, digital investment is the future of India. Digital infrastructure built over the last 8 years will support the business in the medium term. Having said that, downside risks remain, especially if the price of crude oil spikes and risk aversion returns to financial markets in the next few months. General Singh's address comparing the organizational culture in the Indian Army and in the civilian establishments was an insightful take. There are many learnings and actionable points here that can be replicated. His emphasis on respecting culture and diversity is a lesson that is relevant for large organizations like ours. The General succinctly explained the difference between manager and leader, how Army creates leaders, not managers, and how SBI transforms itself through efficient leadership. If trust is developed in system, the organization can pass any hardship it may face. His advice on commitment beyond the call of duty is needed in Amrit Kal. The Economist panel, with a diverse opinion, was optimistic of India's growth story. However, they were not in agreement on all the topics. Some of the key points are the global soft landing is better and lower recession in developed countries is a preferred option to high inflation across the globe. So a soft landing in 2023 is what was recommended by one of the panelists. And India's current account deficit may be a little higher, but manageable given the strong capital flows and software exports. The situation in Europe is worse than US. Asia is better placed in that respect. North Asia, including China, may be a preferred destination going forward, given the low interest rates. These were some of the thoughts put by the economists. Finally, I would like to take this opportunity to thank our chairman for his continuous encouragement and unstinted support, the vision and complete freedom in making the 9th edition of the SBI Banking and Economics Conclave a grand success. The vision of SBI under the dynamic leader of our chairman now manifests in the strong quarterly results, which is getting acknowledged by all stakeholders. My special thanks to all the panelists for taking the time out and sharing their views and giving meaningful insights on the subjects. My special thanks also to the media partner, CNBC TV 18, Pavitra, Shireen, Lata, Sonal, Ritu, and the entire team. Thanks are also due to Shri Soumya Kanti Ghosh, his entire team at the Economic Research Department, the Liaison Department, HR Department, PR Department, Chairman Secretariat, the business groups, who have all given their contribution in making the event a grand success. Very, very special thanks to the directors of the board for their benign presence and the MDs of all the MDs present for their active participation. Last but not the least, a big thank you to all the ground staff of Hotel Trident and the members of the press. I invite you for a cup of tea after this session. Please enjoy the evening. Thank you so much.